Good morning, everybody. Thank you for your time. Today's webinar consists of 6 chapters, and chapter 1, we will start now. 4 key reasons why you should explore systematic trading. The first reason is quite obvious, is the ability to test the strategy before you trade it live. When you use 100% mechanical trading rule-based trading strategy, you do not require a trader's input. You can check if it has actually worked in the past. We call this process backtesting. So what is backtesting? It's intentional testing procedure to verify if your trading strategy actually works using historical market data and conditions. So in short, it's one way to evaluate a trading system or strategy. So this is an example using my hedge recovery EA. You can see the backtesting in process where they'll mark up where the stop loss is, or rather in this case, the opposite hedge trade, and where they enter, where they take profit, and of course, the equity curve. A common negative comment that people give about backtesting is that backtested performance is not a true indication of future actual results. That is true. Very true. Nobody can predict what will happen accurately in the future. Nobody knows, neither me or any other of gurus for that matter. But the thing is, will you put in real money if your guru strategy looks like this? Will you trade a clearly losing strategy? So I think instead of having the notion that backtested strategy may not be accurate reflection of future, perhaps a better question to ask yourself will be, will you commit your savings to trade a strategy if the backtest shows like A, your trading strategy has not been profitable at all for the last 5 years, or B, your strategy worked about 60% of the time and is profitable for all of the last 5 years? Which option will give you more confidence, A or B? Well, let's look at another strategy. This is Quant 1, a system designed especially for Euro USD. It has been used on institutional fund. So you can see while the equity curve is fairly smooth, but you see some dips here, there's some drawdowns here, and this is a quite recent one, which I also suffered. But generally, if you see an equity curve like this, the consistency for the past 12 years, will this give you more confidence that it's likely to continue to work after the initial drawdown? Or this is another strategy, the hedge recovery, which I mentioned earlier on. Will you be more confident to trade a strategy like this, which has worked for the last 12 years? The thing is, really nobody knows if it continue to work in future. But at a bare minimum, we want to trade a strategy who has shown positive expectancy to show that it at least had worked and is still working recently. I mean, otherwise, based on what evidence are you going to trade a strategy? What kind of confidence are you going to develop? So this is where systematic trading has a huge advantage over discretionary trader who basically cannot check if the rules have worked. And if they have, I mean, even if the rules look very profitable, especially if it's cherry pick examples, selectively instead of giving you a 10-year test result, they selectively choose 3 or 4 very good, very big winning trades in the last 5 years. But what's the point? Well, why don't they show also the losses? Because what you really want to see is a full picture, not just the winnings, not a particular winning trade that has a huge winnings. What you want to see is the net of every year, every month, what happened in the last 5 years, so you can have a full picture and what you should do for going forward. Like what the famous Sun Tzu had mentioned, victorious warrior win first and then go to war, while defeated warriors go to war first and then seek to win. It's like trading actually. We should have a strategy, a signal that has shown positive expectancy, shown an edge, a statistical edge before we enter a trade, and not hope that we are right after we enter a trade. Because the thing is, this I think is a common problem among retails. You read something online, it shows basically just 2 or 3 examples, and you think it's a winner and you go in. And you just don't know how and what to expect. 2-3 sample is just not sample at all. The second advantage of systematic trading is that because of the past, we are able to test the system. We know the characteristic of the system. We actually can help to do, or rather limit, the maximum drawdown. This is an example of Con 1. This is based on the back test. Sorry, it's not 11 years, it will be 12 years. The profitable trades is 98.43%. And the average number of consecutive wins of 91 and 1 consecutive loser. And the maximum number of consecutive winners is 288. That is, at one point in time, the last 12 years, there were 288 trades winners in a row and only 3 losers in a row. And I think that only happened once, which led to the worst drawdown in the last 12 years at 12.74%. This is how it look like where discretionary can't really produce and systematic can. You can see at the annual performance how it performed. Its best performance was in 2017. 2019, we had a huge drawdown, which affected the overall performance, but still is overall profitable slightly. This is the annual performance with only 1 losing year in 2014. So using Con 1 as an example, the thing is, since we have very high win rates, as well as very high consecutive wins, and after every, so the thinking is, could we recover faster after every loss if you increase the size of the next trade only after every loss? So while it's very rarely it happens, but when it happens, you have a very high odd and next trade will be profitable. So if you increase the risk slightly for the next trade, would that help you recover faster? And how many trades after that should you go back to normal risk? Alternatively, if you're using a trend following strategy, which basically, let's say most trend strategy has less than 40% win rate and generally have long periods of drawdown. And this is normal because market ranging periods tend to drag on for weeks and months the moment they start ranging. It's usually due to some fundamental reasons, waiting for an outcome, waiting for an interest rate cut, indecision. So with this kind of scenario, could we then reduce the size after every losing trades? The thing is, you will only know all this if you test a system, understand the system, understand the past performance, the maximum consecutive winners, losers, drawdown, how it works. If you know all this, you can actually use this to your advantage to minimize damage or drawdown. So again, this is clearly an advantage for systematic trader because discretionary trader cannot have an objective way to form any expectation on how many losing trades in a row or how big the maximum drawdowns are likely to be, because simply there's no data. It's really based on the expertise and experience of that particular discretionary trader. And with this, on point 2, when we talk very much about understanding the system, the characteristics, all this will lead us to point 3. By understanding all this, you will actually have a positive impact on trading psychology and discipline. Because when you trade with a strategy that has positive expectancy, you are confident, you will naturally develop confidence with your strategy because you know it works and likely to work. And if you manage your risk level well, you're not over risking, it will not create anxiety or panic attacks. And together, collectively, you will just naturally become more confident and more consistent. And of course, this is especially true for new traders. When if you have confidence in a strategy, you are less likely to do system jump, and you're more likely to stick to one system even when it's undergoing drawdown. And this really come to the last point, which is, in my opinion, from a retail trader's point of view, the most important point. Because regardless of who you learn from or what signals or examples you follow, end of the day, it's a performance that matters. Can you duplicate or replicate that performance, the trading performance? There's no point if your guru make 100% a month, 20% a month. But the thing is, you as a trader, the trainee trader, after 24 months, you're still losing because you cannot produce the performance. So no matter how respected the trainer is, or how superior you think his trading style is, end of the day, if you cannot follow the signal, you cannot control your emotion, you cannot duplicate his experience, input, and therefore that to interpret the chart as like the way he did, there's no way you can replicate this trading performance. So this is example. For example, like trader A, B, and C, you see the results. This is something that you can expect as a systematic trader. So imagine trader A, B, and C all uses the same system. They cannot be exactly the same because you will be surprised, or rather you shouldn't be surprised because Forex is over-the-counter product. So even if all trader A, B, and C uses the same broker and the same system, they may get a slightly different price feed from the broker, even if they use the same brokerage. And in this case, sometimes the exit and the entrance can have an impact on the entry or mistrade or end up with the SL because you couldn't get out. But generally, over the long run, all three should have similar equity curve, should follow pretty near, which is the key point of systematic trading, where you can duplicate the same performance of a winning strategy. So in a nutshell, systematic trading can improve all the important core traits of a successful trading. Basically, you can filter trades by the past performance. By looking at that, you're kind of able to decide what strategy suits you, what strategy do not suit you. For example, you do not like the two-mean reversion, you prefer trend following, or people who cannot accept too many consecutive losses, they will naturally prefer mean reversion over trend following. So you can pick a filter system based on the past performance, and obviously you only filter those that shown that it has worked and is continuing working and most likely to continue working in the near future. And by using a systematic or algo to trade, you can actually reduce or miss trades or avoid all the execution issues. Like for example, if you suffered some series of losses, it affect you psychologically, but it will not affect the robot. The robot will continue to trade. Or simply the timing of the signal. You're at work, you're sleeping, but the robot is not. They can help you take the trade. You can also limit the losses as brought up in point 2 by using a suitable money management. It's simply knowing the characteristic of how a trade could go in a series of losses, how your trade will function in a ranging condition. And finally, of course, all these will add up and improve your discipline and psychology. With this, we'll go on to chapter 2, a practical guide to minimizing curve fitting in your historical backtest.